What if I told you that billions of dollars can be wiped out not by a war, not by a recession, but by a rumor? In recent months, the financial world has been buzzing with shocking headlines. Major bank in trouble due to silver trades. Traders lose hundreds of millions overnight. Is another banking crisis coming? Social media exploded. Reddit threads went viral. YouTube thumbnails screamed bank collapse. But here's the real question. What actually happened? Were banks really collapsing? Why did silver suddenly become so dangerous? And how do rumors turn normal market losses into nationwide panic? Today, we're breaking it all down. No hype, no fear-mongering, just the truth behind market rumors, silver trading losses, and bank fear in the US. Why silver matters more than people think. Silver is not just a shiny metal. It's used in electronics, solar panels, medical equipment, military technology. And unlike gold, silver has heavy industrial demand. That means silver prices don't move only on emotion. They move on supply chains, interest rates, inflation, and global demand. But here's the twist. Silver is also one of the most heavily leveraged assets in the market. That means traders borrow money. Banks provide leverage. Small price moves can cause huge profits or massive losses. This makes silver extremely sensitive to sudden price changes. The setup, leverage, margin, and risk. To understand what went wrong, you need to understand margin rating. Here's a simple example. You have $1 million. A bank allows you to trade $10 million worth of silver. Sounds great, until silver drops just 5%. That 5% loss doesn't hit $10 million. It hits your $1 million. That's how traders get wiped out fast. And when multiple traders lose at the same time, banks issue margin calls. Margin calls mean add more money, or your positions get first liquidated. The price shock what triggered the losses. Silver prices experienced sharp, unexpected moves. Why? Several factors hit at once. Strongest dollar, changing interest rate expectations, lower short-term industrial demand, heavy speculative positioning. Too many traders were on the same side of the trade. When prices moved against them, stop losses triggered, margin calls fired, positions were dumped automatically. This caused a chain reaction. Losses piled up quickly, not because silver collapsed, but because leverage magnified everything. How bank rumors were born. Here's where things get dangerous. Some traders lost hundreds of millions. Then someone posted online, a major US bank is exposed to silver losses. No names, no proof, just fear. Financial Twitter picked it up. Reddit amplified it. YouTube thumbnails went wild. Suddenly, bank failure, hidden losses, next financial crisis. But here's the reality. Trader losses, bank collapse. Banks are lenders and intermediaries. Most trader losses are client losses, not bank capital losses. But social media doesn't care about nuance. Why people believe these rumors instantly. This isn't happening in a vacuum. People still remember 2008 financial crisis, Silicon Valley Bank collapse, Credit Suisse failure. Trust in banks is already fragile. So when people hear bank plus losses plus metals, their brain fills in the worst-case scenario. Fear spreads faster than facts, and fear moves markets. What actually happened behind the scenes? Here's what really happened. Some traders were over-leveraged. Silver price volatility triggered margin calls. Positions were closed at losses. Banks tight and risk controls. No major US bank collapsed. No deposits were frozen. No systemic failure occurred. But the emotional damage was done. Markets don't just run on money. They run on confidence. How media and algorithms fuel panic. Social media rewards shock, fear, anger, not accuracy. A calm headline doesn't go viral. A scary one does. Trader losses in silver market versus banks in trouble silver crisis. You already know which one spreads. Algorithms don't ask, is this true? They ask, are people reacting? Lessons for retail investors. If you're watching this as an investor, here are the key lessons. Leverage is a double-edged sword. It amplifies gains and destroys portfolios. Rumors move faster than reality. By the time truth arrives, panic has already done damage. Banks are not the same as traders. Client losses don't automatically mean bank failure. Risk management matters more than predictions. You don't need to predict markets. You need to survive volatility. Could this happen again? Absolutely. As long as leverage exists, social media exists, human fear exists, rumors will keep shaking markets. The next panic might not be silver. It could be oil, crypto, AI stocks, government bonds. The pattern stays the same. The real danger in financial markets today isn't silver. It isn't banks. It isn't even losses. The real danger is fear without understanding. Because when people panic first and ask questions later, markets don't just fall. Trust collapses. If you want more deep, honest breakdowns of financial events without hype, hit like, subscribe, and share this video. Because in a world full of noise, clarity is power.